Test 7, Finance 7.1. What is a lien theory state? A state in which a mortgagee holds legal title to a secured property. B. A state in which a mortgagee has equitable title to a secured property. C. A state that allows a real estate owner's creditors to record liens against the owner's property. D. A state in which a lien is considered as a conveyance. 7.2. What is the function of a note in a mortgage or trust deed financing arrangement? A. It is the lender's security instrument in the collateral property. B. It is evidence of ownership of the mortgage or trust deed. C. It contains the borrower's promise to maintain the value of the property given as collateral for a loan. D. It is evidence of the borrower's debt to the lender. 7.3. When homebuyer Henry pledges his newly purchased home as collateral for a mortgage loan, the evidence of the pledge is the A. Trust deed or mortgage. B. Promissory note. C. Loan commitment. D. Loan receipt. 7.4. The borrower in a mortgage loan transaction is known as the A. Mortgagee. B. Mortgager. C. Liener. D. Trustee. 7.5. If a borrower obtains an interest-only loan of $200,000 at an annual interest rate of 6%, what is the monthly interest payment? A. $1,200. B. $600. C. $500. D. $1,000. 7.6. If a borrower's monthly interest payment on an interest-only loan at an annual interest rate of 6% is $500, how much was the loan amount? A. $72,000. B. $100,000. C. $120,000. D. $50,000. 7.7. A borrower of a $50,000 interest-only loan makes annual interest payments of $3,750. What interest rate is the borrower paying? A. 7.5%. B. 0.75%. C. 3.75%. D. 8.5%. 7.8. Maria borrows $100,000 and pays 2 points for the loan. How much does she pay in points? A. $200. B. $2,000. C. $1,200. D. It depends on the interest rate. 7.9. Which of the following is true of an amortizing loan? A. The amount of annual interest paid is the same for every year of the loan term. B. Part of each periodic payment is applied to repayment of the loan balance in advance and part is applied to payment of interest in arrears. C. Except for any points that may be paid, the interest on the loan balance is usually paid in advance. D. The interest rate is reduced each year to maintain equal payments even though the outstanding loan balance is smaller. 7.10. For a loan that is not backed by the Federal Housing Administration or Veterans Administration, and for which the borrower is making a down payment of less than 20%, the lender is likely to require the borrower to obtain a subrogation agreement. B. Private mortgage insurance. C. A letter of credit. D. A cosigner on the note. 7.11. What is a loan-to-value ratio? A. The percentage of a lender's portfolio that is composed of mortgage loans. B. The ratio of borrowed principal plus total interest to the appraised value of the collateral property. C. The ratio of a lender's return on a mortgage loan to the value of the collateral property. D. The fraction of the appraised value of the property offered as collateral which the lender is willing to lend. 7.12 The difference between what a borrower has to pay to purchase a property and the amount a lender will lend on the property is the A. Mortgage insurance coverage amount. B. Lender's profit margin. C. Buyer's down payment. D. Origination fee. 7.13 The Equal Credit Opportunity Act prohibits a lender from A. Refusing a loan because the borrower does not match the lender's target market. B. Including income from self-employment in the borrower's qualifying income. C. Requiring both spouses to sign the loan application form. D. Refusing a loan because a borrower has a defective credit report. 7.14 A loan applicant has an annual gross income of $72,000. How much will a lender allow the applicant to pay for monthly housing expense to qualify for a loan if the lender uses an income ratio of 28%? A. $2,160. B. $1,680. C. $1,068. D. $840. 7.15 AMC Bank discovers, in considering buyer Bob's application for a mortgage loan, that Bob has borrowed the down payment from an uncle and has to repay that loan. Bob should expect that AMC Bank will A. Refuse the application. B. Adjust the applicant's debt ratio calculation and lower the loan amount. C. Increase the loan amount to enable the borrower to pay off the loan to the relative. D. Require the borrower to make payments to an escrow account for repayment of the relative's loan. 7.16 The Federal Reserve's Regulation Z applies to which loans? A. All loans. B. All loans secured by real estate. C. All loans secured by a residence. D. All loans over $25,000. 7.17 If a particular loan falls under Regulation Z's right of rescission provision, A. The lender has the right to change the terms of the loan within a certain period. B. The lender has the right to accelerate repayment of the loan because of a change in the borrower's credit status. C. The borrower has the right to pay off the loan ahead of schedule with no penalty. D. The borrower has a limited right to cancel the transaction within a certain period. 7.18 Under the Equal Credit Opportunity Act, a lender, or a real estate agent who assists a seller in qualifying a potential buyer, may not A. Tell a rejected loan applicant the reasons for the rejection. B. Ask the buyer/borrower about his/her religion or national origin. C. Ask the buyer/borrower to explain unconventional sources of income. D. Use a credit report that has not been provided to the borrower. 7.19 A conventional mortgage loan is one that is A. Backed by the Federal National Mortgage Association. B. Insured under Section 203, B, of the Federal Housing Administration Loan Program. C. Guaranteed by the Government National Mortgage Association. D. Not FHA insured or VA guaranteed. 7.20 The assumability of an FHA insured loan is A. Unrestricted. B. Limited by when the loan was originated. C. Limited to owner-occupied properties. D. Prohibited on all existing loans under current regulations. 7.21 A VA Certificate of Eligibility determines a. How long an individual served in the military. B. The maximum loan amount an approved lender can give to veterans. C. How much of a loan the VA will guarantee. D. Whether a lender is approved to issue VA guaranteed loans. 7.22 A borrower obtains a 30-year, fully amortizing mortgage loan of $50,000 at 8%. What is the principal balance at the end of the loan term? A. $2,000. B. $50,000. C. $220. D. 0. 7.23 Which of the following describes a purchase money mortgage financing arrangement? A. A bank gives a buyer a senior mortgage loan that fully covers the cost of purchasing the property. B. The buyer gives the seller a mortgage and note as part of the purchase price of the property. C. A land trust holds title to the property while the buyer makes periodic installment payments to the seller. D. The seller uses the purchase money obtained from the buyer's mortgage loan to repay the seller's outstanding loan balance. 7.24 A homeowner borrows money from a lender and gives the lender a mortgage on the property as collateral for the loan. The homeowner retains title to the property. This is an example of A. Intermediation. B. Forfeiture. C. Hypothecation. D. Subordination. 7.25 Which of the following correctly describes the flow of money and documents in a mortgage loan transaction? A. The borrower gives the lender a note and a mortgage in exchange for loan funds. B. The lender gives the borrower a mortgage and receives a note in exchange for loan funds. C. The borrower receives a note in exchange for a mortgage from the lender. D. The lender gives the borrower a note, loan funds, and a mortgage. 7.26 In a deed of trust transaction, which of the following occurs? A. The beneficiary conveys title to a trustee in exchange for loan funds. B. The trustee conveys title to a beneficiary in exchange for loan funds. C. The trustor conveys title to a trustee in exchange for loan funds from the beneficiary. D. The trustee conveys title to a trustor in exchange for loan funds from the beneficiary. 7.27 A lender lends money to a homeowner and takes legal title to the property as collateral during the payoff period. They are in A. Title theory state. B. Lien theory state. C. State allowing land trusts. D. State where hypothecation is illegal. 7.28 A lender who charges a rate of interest in excess of legal limits is guilty of A. Redlining. B. Usury. C. Profit taking. D. Nothing. There are no legal limits to interest rates. 7.29 A lender is charging 2 points on a $60,000 loan. The borrower must therefore pay the lender an advance amount of A. $120. B. $300. C. $1,200. D. $3,000. 7.30 The difference between a balloon loan and an amortized loan is A. An amortized loan is paid off over the loan period. B. A balloon loan always has a shorter loan term. C. An amortized loan requires interest payments. D. A balloon loan must be retired in 5 years. 7.31 A distinctive feature of a promissory note is that a. It is not assignable. B. It must be accompanied by a mortgage. C. It is a negotiable instrument. D. It may not be prepaid. 7.32 When the terms of the mortgage loan are satisfied, the mortgagee A. may retain any overage in the escrow account. B. may inspect the property before returning legal title. C. may be entitled to charge the borrower a small fee to close the loan. D. may be required to execute a release of mortgage document. 7.33 In addition to income, credit, and employment data, a mortgage lender requires additional documentation, usually including a. an appraisal report. B. a criminal record report. C. a subordination agreement. D. a default recourse waiver. 7.34 The three overriding considerations of a lender's mortgage loan decision are a. points, interest rate, and loan term. B. the location of the mortgaged property, the borrower's cash, and the amount of the borrower's equity. C. the ability to repay, the value of the collateral, and the profitability of the loan. D. the amount of the loan, the borrower's income, and the down payment. 7.35 The reason lenders consider the loan-to-value ratio important in underwriting is that a. they don't want to lend borrowers any more money than necessary. B. they want to ensure there is more than enough collateral to cover the loan amount. C. borrowers can only afford to borrow a portion of the entire purchase price. D. the higher the loan-to-value ratio, the more profitable the loan. 7.36 The Equal Credit Opportunity Act, ECOA, requires lenders to a. extend equal credit to all prospective borrowers. B. consider the income of a spouse in evaluating a family's creditworthiness. C. discount the income of a person involved in child rearing or childbearing. D. specialize lending activity by geographical area for improved customer service. 7.37 Lenders use an income ratio in qualifying to a. ensure a borrower has the earning power to make the loan payments. B. compare a borrower's earnings to the borrower's short-term debt. C. identify the highest possible interest rate that the borrower can afford. D. quantify the borrower's assets to the fullest extent. 7.38 The debt ratio formula used to qualify borrowers is a. total debt divided by debt payments. B. gross income divided by assets. C. gross income divided by debts. D. debt payments divided by gross income. 7.39 At the closing of a mortgage loan a. the borrower pays off the note and receives clear title. B. the lender issues a firm loan commitment. C. the parties complete all loan origination documents and the loan is funded. D. the borrower's loan application is complete and the file closed. 7.40 Which laws or regulations require mortgage lenders to disclose financing costs and annual percentage rate to a borrower before funding a loan? A. The Equal Credit Opportunity Act. B. Truth in lending laws and regulations. C. The Real Estate Settlement and Procedures Act. D. Federal Fair Housing Laws. 7.41 Which laws or regulations prevent mortgage lenders from discriminating in extending credit to potential borrowers? A. The Equal Credit Opportunity Act. B. Truth in lending laws. C. The Real Estate Settlement and Procedures Act. D. Federal Fair Housing Laws. 7.42 Which laws or regulations require mortgage lenders to provide an estimate of closing costs to a borrower and forbid them to pay kickbacks for referrals? A. The Equal Credit Opportunity Act. B. Truth in lending laws. C. The Real Estate Settlement and Procedures Act. D. Federal Fair Housing Laws. 7.43 Which of the following are methods used by the Federal Reserve System to regulate the money supply? A. Selling securities, printing money, and controlling lending underwriting requirements. B. Buying securities, changing the discount rate, and controlling banking reserves. C. Printing money, changing interest rates, and selling T-bills. D. Controlling the prime rate, trading securities, and purchasing loans. 7.44 How does the secondary mortgage market aid borrowers seeking a mortgage loan? A. It cycles funds back to primary lenders so they can make more loans. B. It issues second mortgages and sells them in the home equity market. C. It lends funds to banks so they can make more loans. D. It pays off defaulted loans made by primary mortgage lenders. 7.45 The major organizations operating in the secondary mortgage market are A. Fannie Mae, Freddie Mac, and Ginnie Mae. B. Fannie Mae, GMAC, and MGIC. C. Freddie Mac, FHA, and VA. D. Fannie Mae, Freddie Mac, and the Federal Reserve. 7.46 What is the role of Fannie Mae in the secondary mortgage market? A. It guarantees FHA-backed and VA-backed loans. B. It insures FHA-backed and VA-backed loans. C. It purchases FHA-backed and VA-backed loans. D. It originates FHA-backed and VA-backed loans. 7.47 What is the role of the Federal Housing Authority in the mortgage lending market? A. It guarantees loans made by approved lenders. B. It insures loans made by approved lenders. C. It purchases loans made by approved lenders. D. It originates loans made by approved lenders. 7.48 What is the role of the Veterans Administration in the mortgage lending market? A. It guarantees loans made by approved lenders. B. It insures loans made by approved lenders. C. It purchases loans made by approved lenders. D. It originates loans made by approved lenders. 7.49 In a graduated payment mortgage loan, A. Loan funds are disbursed to the borrower on a graduated basis. B. The interest rate periodically increases in graduated phases. C. The loan payments gradually increase. D. The loan payments gradually increase and the loan term gradually decreases. 7.50 In a buydown, A. The lender lowers the interest rate on a loan in exchange for a prepayment of principal. B. The borrower pays additional interest at the onset in order to obtain a lower interest rate. C. The lender requires the borrower to buy down the price of the property by increasing the down payment. D. The borrower pays the lender additional funds to buy down the term of the loan.